This has been too orderly. The drawdown has been too orderly, and in my opinion, it's material. It's not just going away. Will they find it again? Sure, they could find some silver again, and at the right price, you find a lot of silver. Scrap is just like overnight, but at the right price.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. And in today's show, we have part 2 of my recent interview with Vince Lanci, where first he digs into the EFP mechanism, breaks down and explains how that actually works and what it means when you hear that term. And then after that, he explains his take on what's going on with the metal that we see leaving the COMEX registered stockpile, as well as the London inventory. So always great to hear from Vince. And with that said, here we go with part 2. Yeah, and Vince, actually, one thing perhaps you could shed some light on, because I think people hear about the EFP and that mechanism between London and New York, but could you just elaborate for people who might be a bit newer to it when you say the
Sure.
EFP buying and how that the mechanics
Sure.
of that actually works and what that means?
Sure. I can give you the history of how I learned it. I learned it very quickly because I traded it. I didn't trade it to make money, but before there was an overnight futures market in metals in like 95, what you would do is you would trade the physical, and the next day the COMEX would let you post it. So it's kind of like I buy physical and then I would swap it out at whatever the EFP was. And the EFP was very stable. So the EFP is very important in precious metals, more important than any other market, because it represents two different exchanges. So the EFP is the exchange for physical. People stop using that term, but that's what it is. So if people generally take delivery in London on the LBMA, but the pricing mechanism is generally recognized as the COMEX, what you have is you have assuming that there's no friction in the world. EFP should be spot market, which is London. It could be in the US, but it's in London. Should always trade, always is not the right word, but generally should trade underneath futures.
Right.
Because for your listeners, if spot is worth $20 in silver, then spot plus 1 month should be the cost of silver plus the cost of storage plus the interest rate. So it's $20.20, whatever, right? And that's how it works in every financial market, meaning stocks, meaning bonds. And I'm not talking about curve inversion, it's something different, meaning stocks, bonds, and gold. And people think silver needs to act that way. It doesn't. Silver, and that's another conversation, but so generally speaking, when silver rallies, it rallies like this. So if silver goes from 20 to 21, the future should go from 10 cents over to 20 cents over, because it costs more money. So the spread goes like this. When we rally, the spread goes like this. Now, there's exceptions during rollover, but I'm not going to get into that now. But the key now is this, is there were times when I was trading the EFP actively because I had to, where I'm like, okay, I sold 10 silver, let's say, right? And the guy would be like, I go, where's the EFP? And I'll say, oh, it's 5 cents. So I basically sold spot 5 cents of their futures, and tomorrow they'll flip it out at that spread. Like I was locked in, right? And then every so often during 97, it was like, where's the EFP? It's 1 cent the other way. I went, oh, what do you mean? I didn't know. Like, I was an options guy. What do you mean it's the other way? Because, well, spots over. I'm like, spots over futures. Well, fuck that. I don't want to sell. I'm like, wait. I was like, yeah, I do want to sell that. That's good. So I'm smart. I'm going to buy. I was like, yeah, I'm buying futures. He's like, no, you don't like that. I'm like, why? He goes, because generally speaking, in a real market, this is the key. Put your tinfoil hat on, right? In a real market, spot determines futures price. Dog tail. In a market that's bifurcated, London and US, and the flows are here, but the metal is there, silver futures can dictate spot. If there's no physical demand, but there's physical demand, but it's nothing urgent, right? Then if silver rallies, you will see this, whoop, right? And if silver drops, you will see this. So this becomes actually more volatile than this. And the price we see this every day. We see this in the market now, right? So that's the mechanism. Because it's two different countries, because it's artificially cross-regulatory arbitrage. Not anymore, but it was. So you say, okay, I understand. So it's two different markets. And from time to time, this would happen. Spot would go over silver. And I call my friend, like, Joe, why is that happening? He goes, oh, because the guy who wants the physical, he messed up. The refiner's on vacation. So he doesn't care. He has to do a deal. He's running a business, right? So, and the next day it'll be gone, right? And you also see that in SIFO, the silver offered forward rate, silver forward rates. But you never saw it go backwardated by more than a penny or 2 pennies or maybe a nickel. But here's the key. It's not the price. It's not the differential that mattered. It does matter, right? But it's the chronicness of it. So it would be like this. It'll be backwardated by a penny, and then it'll go backward at 5 cents, and then it's gone. I'm like, what happened? And Joe would say, they found the silver. I go, what do you mean they found the silver? Well, they had someone on the hook and they just squeezed it for 5 cents. 5 cents. That's what they were playing for. But now you've got your coin buyers, you've got your collateral split between Russia and the US. Not that they have a lot of silver, but you have collateral split. You have demand in East Asia for silver, and you've got supply here that doesn't want to leave. And so now you have your normal contango, and then silver drops, and the spread comes in because it should, and then the market does this, and then it does this. I'm like, what's going on? Now I know what's going on, right? Now I know it's the funds are selling it. Sold. They want to get short the CTAs, right? CTAs are selling it. And the spot market does not care. The tail's wagging, dog's giving it the finger. So it stays like this. Why does it stay like this? Because guys like you and me aren't trading the LBMA going, sold the physical, but so you would sell the spot and you'd buy the futures, and in 30 days, you're capping, you're making 10 cents. When the storage cost is only 1 cent. It's a month of storage, right? Okay, so what's going on here? It's like, oh, when are they going to find the silver? They're not finding the silver. And so the EFP went like this. It went normal. The market drops $1. Oh, silver's down $1. Silver sucks. Boom. It goes flat. I go, oh, that's kind of cool. A little bit of physical demand. Then it drops again. I'm like, oh my goodness, it's 10 cents. And then it drops again. It's 15 cents. So the urgency on the buy side is less patient than it used to be. And the funds on the sell side are more impulsive than they used to be. They're not even aware that an EFP exists anymore, these knuckleheads. And then the market will rally. And it's not because the physical is being bought. The physical guy's like, this is what I'm bidding. I'm not chasing it. I'm running a business. The market rallies and the funds go, oh no. And it goes like this. And the funds rally. And the physical guy goes, I'm not going to chase it. I don't care. So you make money trading the volatile. It's almost like, this is almost like a more volatile than this. So it's like a beta. It's a high beta spot, And so they're trading the volatility in the futures. The banks are. So they're buying it here and selling it. And then when it rallies, they're selling it. They're buying. They're making their money like market makers. So the EFP. Now here's the payoff. So now I start seeing this. The market drops. EFP goes over. Spot goes over futures. Market rallies. And this is in July. July it went like this. And I went, oh, there's that 50 million coin purchase. Maybe it has to do with that. Maybe they're sourcing it. Who knows? Then the market rallies and went away. I said, okay, no problem. The market dropped again. And I went, oh, it came back. Wait a minute. That's not, maybe there's more coin buying. Okay. So, I cover my shorts and the market rallies and it goes away again. The market drops a little bit, not a lot, and it comes back. Not big, but enough. And I go, oh, this is becoming a cyclical problem. And the more it becomes accepted as normative behavior, the bigger the problem when it finally happens. And so the EFP is a valuable monitor, almost like an oscillator, telling you when a market has more buying than selling, even though the sellers are winning, right? And if you have a hard time understanding it from the whole EFP aspect, it's kind of like this. We know that when a market is in backwardation on the future side, front to back, you're saying we need it now, we don't need it next year, right? So we need it now, we don't need it next year. I don't care how much cheaper it is next year, I want it now, right? Well, when the EFP goes like this over front month, it's the same thing. I want it now, not 30 days from now. And if this becomes an unchecked problem, you will see silver futures start to bleed. They'll start to follow. Spot will start to dictate market. And isn't that what we're all here for? Spot dictating market, because the COMEX is shrinking in relevancy because of the deliveries being taken on silver, because of demand coming out of Asia and the East for silver and Eastern Europe. So I believe, and this is where I'm coming in at. I believe we're in the next stage of post Basel III, silver being not remonetized. Remonetized is probably a good word for it. Silver being remonetized and spot taking its place at the table of dictating the futures price. Does that help?
Mm-hmm. And actually leads into the next thing I wanted to run by that you touched on a little bit there, because something that has gotten a lot of attention in the silver world. We look at the registered stockpile on the COMEX, which ever since silver squeeze was about 150 million ounces. There was another withdrawal yesterday on Monday. So down to 41.1 million ounces. Again, to be clear, that's still higher than at other points. So this isn't the lowest we've seen. Although interesting, it's not as if that metal has been going over to London. Here is the data that's available back to 2017. They had 951 million ounces then, had been quite a bit higher, over 1 billion ounces, yet significant drop over the last year or so. And like to credit Ronan Manley, who was the first to point that out. He also mentions how of the 18,000 tons, of the 28,000 tons that the LBMA holds, 18,000 are for the ETFs. So that's really only about 320 million ounces that is in their stock. So I've been curious if you have any thoughts on where this metal is going, if that's adding to the pressure. One last data point I'll throw in before you take it from there.
Sure.
We've seen some big India silver import numbers. I believe this was July, was this big boy at 1,800, which even if you go back 10 years is the largest. And we did have an updated one about 1,000 tons in August. This is from Metals Focus. So we see metal coming out of the two main stockpiles, and at the same time, we're seeing premiums rise on retail. Hearing from a couple of dealers, especially, it's been accelerating the last weeks. A lot of products now in delays. So how does that fit into all of what you've been describing?
Silver futures market is going to die a death of 1,000 cuts, and you basically just described like the top three cuts. The first one, I'm quoting the late great George Giro, who was a mentor to me in precious metals futures. When the metal rose from say 17 or 16 to 21, when the registered stockpile rose, it was in part, and you can't quote me on this, but I'm going to say it anyway. It was in part the metal just moving from London to the US for some reason. I don't know why. And so you're going to hear pushback from people saying, oh, it's just the metal moving from US to London. And that may be true. Now I'll just throw a little flow analysis. This has been too orderly. The drawdown has been too orderly, and in my opinion, it's material. It's not just going away. Will they find it again? Sure, they could find some silver again, and at the right price, you find a lot of silver. Scrap is just like overnight, but at the right price. And just to digress for a second, the bank behavior tells me we're nowhere near the right price for that silver to come out of the ground or come out of someone's vault. The first comment about the silver is, and this was, my comment was going to be independent of what Ronan said, who, by the way, I'm a big fan of. He was one of the guys that maybe helped me under, well, I didn't talk to him, but I read one of his pieces. He's one of the guys who, in 2016, wrote a piece on how China's market structure works. It was phenomenal. And I've been reading it. I mean, it's hard stuff to read sometimes, but thank goodness for guys like that. But the silver is going somewhere. Here's what I mean. Back in the day when they would play games, pretend there was a short squeeze, you would see 30 million ounces being pulled out of the vault. And I would talk to guys like George Giro, and they would say, no, that doesn't happen. I go, what do you mean? He goes, you can't take 30 million out. You can't do it. You can only take something like you can only take 3 million ounces out a day in terms of the labor involved. He goes, they're throwing a sheet over it, saying it's theirs, it's not there anymore. But it's still there. It's not going anywhere. So just to get the cautiously paranoid part out of the way, maybe the sheets are thrown over it again, and they're orchestrating a short squeeze. I don't think that's the case because it's come down so orderly. It's very methodical, and the day when they wanted to play that, it'd be like, bing, or, it would just drop precipitously. Like I just took 100 million ounces and put it in my backyard or something like that. Anyway, so that's the first kind of speculative comment. And I'm not going to be a lot of help on where it's going, but I can tell you from experience and from understanding market structure that I can say these things that are true. If you talk to someone who's not bullish on silver, they're going to say the price isn't up. That doesn't matter, right? And we're not going to go through the whole paper versus physical, because at some point there's got to be enough arbitrage in there to clean it out. I think there is someone based out of Europe. I don't have information on this other than what I've heard, and it's not even conjecture, right? It's speculation, conjecture, and truth or fact. It's educated speculation. I know that the bullion banks are historically not big fans of arbitraging silver, letting silver run on the backwardation thing. They like to arbitrage it. They have a mandate in some way to do it, especially with gold. I also believe that somebody who doesn't play well with the bullion banks, like a Soros, like a Buffett, may be playing the game again. It may be an Andy Hall type. He's an old fibro guy. I'm not saying it is. I'm not implying it is. He was an oil guy who, by the way, when Buffett bought silver, Andy Hall was in there. I'm like, oh, okay. Buffett's buying silver. I guess I'll do that. Like these guys they see the flows, right? So I suspect, I have zero information except a lot of experience, that for it to be going on this long and for the banks to not bitch slap it, and the banks are now getting long, and the banks recognize a big player. In 2011, it was whoever bought. In 90, it was actually Blythe screwing some people over. In 97, it was Buffett. The banks got out of the way. In 94, it was Soros. Most of the banks got it. Whoever didn't got killed, right? Someone got killed. The producers got killed in 94. In 97, the producers got killed. In 11, the futures traders got killed, and some refiners. Anyway, so because it's not coming out in because it's coming out in an orderly fashion, and the market's not being disturbed, it's kind of being lulled into a sleep. I think it's real. So I'm 60-40, it's real. And every time something happens, like this whole EFP thing, I think it's more real. So my short, completely speculative answer is somebody is not playing along the bullion bank's rules. He's big enough that the bullion banks will not bitch slap him back into place. And he's doing it. And, now take my little key thing. How do you know it's not like a sovereign fund on the other side of the sanctions? You don't know. I mean, there's still, they're dealing in Russian silver, they're dealing in Russian gold. Not that there's a lot of silver in Russia, but I mean, we've seen who's good at cooking the price of metals. Now I'll throw something at you to really get it going. The Russians are world-class palladium manipulators. World-class. When the Russians, look, this is from a metals guy, his opinion. I want you to apply this to silver. Silver's not worthless. Palladium is worthless. It's granular. It doesn't have a high density, but it really, really is good for gasoline catalytic converters. And there's like 2 places in the world that make it. You got South Africa and Russia. I'm generalizing, but Russia has all this palladium. It's probably worth like $50 an ounce. And they have been crushing the palladium market for a decade. And when this started happening, I was like, oh, look at platinum's under gold. Wait, palladium's over platinum. What's going on? Well, the gasoline catalytic converter, and I promise you, the Russian trading arm, Putin's a trader. He's playing with natural gas, right? They started to telegraph that, you know what, we're gonna run the palladium market. And the players at the time, I could be wrong, but players at the time back then were Morgan Stanley. Morgan Stanley was the palladium market maker, and JP Morgan as well. Morgan Stanley was the bank, if I remember correctly. And so they probably had a bad quarter, and then they just started running everyone else. You saw it happen in palladium. It will happen in silver, just not as crazy. Palladium, the funds are long, the funds get killed. Russia decides they want to start buying it. They start buying or not selling it as much. And then the funds start saying, well, we're going to sell it in the hole. It's what's going on in silver now. It's not going to be a carbon copy. It'll be slower. It'll be bigger. And God forbid, if they announce a gold standard, what happens to silver? It goes to the moon. It goes to the moon. People think, oh, they announce a gold standard, silver's not money. Yeah, but silver's monetized because it tracks gold. And so you'll start to see a relationship. I tell you, if they were to announce some sort of a gold standard or a Bretton Woods 3 or a Plaza Accord 2 where gold's part of it, silver goes to the moon. I mean, it's insane. And which brings me to India. I don't know much about India. I used to know a lot about India. In fact, whenever we used to buy 20 lots, it was called a lakh. Yeah. That term, I was a kid, like, what's a lakh? A lakh is what 20 contracts of silver are. Like, what's a lakh? I don't know. Well, apparently it means 1 million ounces or something like that. I don't know what it means, but it's an Indian term. And I didn't find that out until, believe it or not, like last year. And if you look at what's going on during the sanctions, who's making money? This money is going into silver. Remember how you and I talked off air? We're like inflation. Why didn't the money go into silver? We were discussing how the market structure steers money away from it. They're not steering India away from it. Okay, and so just to give you the mechanics of it, we sanction oil. Boom. Okay, here's an example, not the example, right? Right. So Russia now is held hostage by our sanctions, and they can sell oil to India, but it has to be at a lower price. It's going to be lower. They're going to negotiate, right? We're not going to sell it to you at this. We won't sell it in the middle somewhere, right? But Russia's okay because the Russian ruble is stronger. So Russia's getting the same money. They're getting the same money. India is getting a discount. What's India doing with the discount? They're buying more metal. They're buying more metal. And that's just not, I mean, you see the numbers. You showed me the numbers. That's not me making it up. I know they're buying silver in Turkey. One of the Colfix guys is in Turkey. And he's like, what do you think? And of course I gave him, buy or sell. He goes, well, yesterday somebody bought silver here and big, local, but big. So, a finance guy bought silver and had it shipped to London. Because people are getting their wealth out of Turkey, whatever's going on there. So it's the Middle East buys silver too. It's the poor man's silver out there as well. Poor man out there as well. So India's buying. That's not fake, and that's consistent with the newfound. Like every sanction that we have, for better or worse, enriches India, China, Israel, and anyone else who's a broker. Russians are selling their oil to Saudi Arabia, to China at a discount, or Saudi Arabia. And Saudi Arabians are selling it to Europe at the regular price. Saudi Arabia is the mafia, okay? Or to put it in trading terms, they're Mark Rich in the 70s, Glencore, right? So Glencore got in the middle. And so Saudi Arabia is buying. This is a physical trader talking. Yeah, Saudi Arabia is the intermediary. Well, India is the intermediary for silver. They are an intermediary. And if you look at geographically, India and Israel, they're in the right spot. I don't know what Israel's doing, but I know that they're going to be involved in natural gas. You watch. There's going to be a pipeline in there somewhere, and they're going to be involved in it because they're in the time zone that matters. As demand, I'm going off on a tangent, but it's relevant. The metal that's in the US is going to London. The metal that's in London, I bet some of it's going to India. It's the metal is moving to where the demand is. Here's a truism. In physical commodities, pricing power eventually moves to the region of demand, not supply. So, for example, when the NYMEX started a sour crude contract, sour crude was well, actually, it's not a good example because it was a bad contract to begin with. The point is, if you have a physical commodity, demand is the region of demand matters. If I want oil and I'm going to use it, well, the commodity thrives if the delivery point is in the country that has the most demand, US forever, right? Well, the delivery point for metals where the wealth is was the West, And now the newly minted affluent are in the East, China, right? So the demand is in China. And I watched this. In 2015, 2016, you started seeing India, DGCX, the gold exchange. It didn't do well at the time, but it was open, right? And then you saw JP Morgan opened a vault for silver. JP Morgan opened a vault for gold. So what's happening is the demand is here. The vaults get opened up there. Eventually, an exchange that has a delivery point here will start doing more volume. And when that happens, the pricing power goes to the place of demand. Why am I saying that? COMEX is being drained. India and China are being filled. COMEX is being drained through London to China. It's like some, Marco Polo journey. That's what's happening. Silver is going to the region and gold, but silver is going to the region of demand. And I'm 99 and 2/3% sure that's what's going on. So your India comment, I'm like, yeah, I'm not surprised. And so you and I look at each other and we go, well, why isn't it higher? It's not higher because I believe that I really grossly underestimate the power of financialization and the centralization of it. And they'll let silver go. But I don't want them to now. You know what I mean? Like I want to buy it now. I want to buy more now. Let's put it that way. So that's it. That's so. What's the third thing you showed? You showed the ounces, which I can't really comment on, except that it's Oh, there's one other thing. Ronan said a comment that I thought was incredible, but I thought of it for different reasons. I said, you know what? There may be 100 million ounces of silver in there, but it's like going to a store. You're Bill Gates and you go to a store and you say, oh, there's only 5 iPhones left. Hold 4 for me. I'll be right back. Dude, if there's 100 million ounces of silver in there, 80 million's already spoken for. It's on reserve. It's on layaway, and it's probably on layaway by the government. We use a ton of silver in nuclear work as well. Not anymore, but we did it one time. Anyway, so the 3 points, the India, yeah, that's real. The demand in the East, that's real. The price, that's not real. But I'm not being paranoid about it. And by the way, just as a caveat, it is the West's, the G7's stated goal. If the East, looking at oil, if the East is withholding, collateral in the form of oil, then we're going to lower their price with sanctions. So we're countering all these collateral problems with financial sanctions. What does that mean? Well, we're going to sell oil futures rehypothecation to keep it down. They're doing that in silver and gold too. They don't want the price of gold to go up because if we can look for the G7, look for Davos to start talking about gold being not green. That's what I think is going to happen next. Anyway, that was a very long-winded reply. I'm sorry.
No, well, it was great getting some insight into what's going on there. And I know in your one of your emails and post on the Goldfix Substack, you shared that tweet yesterday of a warning. Are we going to see the G7 start demonizing gold? So
yeah, that was yeah.
Which would seem like perhaps a little bit of a sign of desperation if they feel a need to do that. And I guess we'll see in time how that plays out. And certainly an interesting environment. And as always, Vince, I appreciate you breaking things down. And perhaps you could just mention where people can find you at the Goldfix Substack, because certainly if you enjoyed what Vince is sharing today, I've really enjoyed your site here where you dig into a lot of these things. There was yesterday's post about the silver rallying 8%.
Yeah, where I was just totally wrong and I had to change it. I was like, silver rally's 4%, silver rally's 8%. Wait a minute, it's not stopping. Yeah, it's Goldfix. It's goldfix.substack.com. I think that's what it is. Anyone, last time you had me on, you asked me about Twitter, and I said it's not the same as the Substack, in terms of the demeanor and tone. I got banned, so I don't have a Twitter account anymore. I'll let you know when I have one soon. But thank you very much. Yeah, this is it's an interesting time for metals, especially silver.
Well, it sure is. I mean, it's quite a complex environment, especially we didn't even dig into the Fed too much today with everything that's going on there. But, we have interesting the whole situation in London last week where they're running into problems with their bond and currency markets. Interesting how quickly things shift going from quantitative tightening to quantitative easing. And it's been great having your column. I've really enjoyed reading that every day where you dig into these things and help explain some of the things that are going on out there, much like you did in today's call. So Vince, can't thank you again enough for joining me today, and a lot of great stuff you shared there, and we'll just have to look forward to doing it again soon.
Chris, I love shooting the shit with you, especially before we even go on the air. That's the good stuff. But it's not age appropriate. Thank you for having me. I really like it. I wanted to ask you about the UK. Do you think that's done?
It doesn't seem like it, and I mean, it's another one of those things that gets patched up, yet especially as I was learning about these LDIs, where another one of those where you try and get a return and then you just amp it up another 20 times over. I mean, especially when you have the issues of the deficits they're running and they're facing the same problem with inflation there. So they're backed into a corner where some side of it seems like it's going to pop up. You like the whack-a-mole, you trying to fix the bond rates here, and then you have inflation still soaring. So it seems like we haven't seen the end of that one.
Can you have any confidence? I mean, like you made the comment about from quantitative tightening to quantitative easing, like in a day. I can't believe anyone has any. It's like Santa Claus. I can't believe has any confidence in what's going on. If you can go from quantitative tightening to quantitative easing in one day, how are we not making the same mistake? That's what I mean. What do you think? I mean, do you think we're going to get a pivot or not?
Well, that was what was shocking, seeing how quickly that can be reversed. And I get it, where we've watched Jerome Powell all year say that he wants to fight inflation, which, makes enough sense. Although seeing that perhaps maybe we're one or two things away from breaking. You have Credit Suisse not doing so well. You have Japan intervening in the yen 2 weeks ago.
Right.
Still sinking. And like you pointed out, it's just a quick reversal. What happens? Okay, if England finishes the quantitative easing, what happens when they go back to tightening? I mean,
right. I mean, you what did you say? You said desperation. Yeah, I mean, the signs of desperation are well, desperation is not the reversal. The reversal is well, I mean, desperation is the reversal, but coming out and selling it the way they sold it. That's the desperation. It's only temporary. And then what do we see?
Then they even reverse the tax cuts too.
They reverse the tax cuts, right? Truss is like, she came in like, I guess, like Thatcher or like Reagan, wanted to lower taxes.
Yep.
And now she's raising. I mean, are we that stupid? I mean, economically?
Well, it still goes back to the same. There was no spending cuts along with those tax cuts. So it's still the same underlying dynamic to me where they're trying to avoid that the money's not there, then let alone the whole energy situation and a whole bunch of other things piled on top of that. And so, no, I don't think we've seen the end of that. And I wonder if something like that is what could ultimately change the Fed's course of action.
What makes us wrong then? That's a real question. Like, I can't find, it shows my bias. What makes us wrong? I mean, confiscation? What makes us wrong? I don't know. How do they get out of it?
I think it's just perhaps the timing. Will it happen this year? Maybe, maybe not. Will it happen next year? Maybe, maybe not. But
Right, right.
that's
I-
what I think led so many people into the metals over the past decade, because following collapse of the housing bubble, we saw a crisis caused by debt and money printing
Right.
solved with more debt and money printing, and it's gone on for longer than I think most thought was possible, yet it's still out there, which hasn't gone away.
The Fed can stay irrational longer than we can stay liquid. I guess that's how we should say it now.
That certainly does seem to be the case.
It feels like it after the horrendous several months that we had. Anyway, so maybe we're out of some sort of woods now. I'm excited. Not too excited, right?
Well, we will see what happens. Who knows? Maybe it'll be before the next time we catch up, but we'll have to do that again soon. And just thank you again for making your time today for another great call and shedding some light onto all this.
It was a riot. Thanks a lot, man. Thank you for letting me go off. Thank you.
Well, thank you again, Vince. Sure was great to catch up with him again, and his knowledge of silver and the inner dynamics of what's going on sure are pretty incredible. And I hope you found this episode helpful for everyone watching at home. And we'll look forward to having Vince on again soon, especially as the action in the silver market picks up. Hopefully, a continuation of the rally. And real quick, before we wrap up, I'd like to thank Silver Viper Minerals for bringing us today's show. Silver Viper, who has been exploring their El Ruby project, where they recently found some new mineralization targets. And for a quick word about that, for my last call with Steve Cope, here's what Steve had to say about it.
But one of the things we've seen is, and one of the things that we believe this type of deposit will produce is at a deeper contact between two different host rocks is where there should be a massive blowout of high grade mineralization. You know, the similar deposits around the world are multi-million ounce gold deposits. So we're excited, and we wanted to try and vector in on where the best spot to drill would be to hit that target. Then when you were looking at the geophysics slides and you see these blind targets under surface, that's sitting under some of those. And those are very compelling geophysical targets coming in, you know, between magnetic lows, and are very interesting things to test and possibly make new discoveries where, you know, in that area, you're probably sitting a little higher up in the system, and the main part that could be another El Ruby or larger is sitting undercover.
Well, thank you, Steve. And you can find out more about Steve and Silver Viper at silverviperminerals.com. Appreciate them bringing us today's show. Thank you also to Vince for everything he shared in that interview with some reasons for optimism in the silver world. And of course, thanks to everyone watching at home, because there would not be a show without you. And I sure do appreciate you being here. That said, we will wrap up for today, but I will see you again tomorrow.